Okay, so you want to own a roofing company. A storm moves across town, the phones start ringing before the rain has stopped, and suddenly every street seems to contain a 5-figure job. The customer owns the house, the supplier delivers the material, a crew does the physical work. You sell the roof, pay everyone involved, and keep the difference. That is the picture. Now put one leaking house inside it. Water is appearing near a ceiling light. A salesperson drives out. Climbs onto the roof, takes photographs, measures everything, and writes a proposal. The homeowner signs. Material is ordered. A crew is scheduled. The contract goes onto the board. From the office, the job already looks like revenue. It is not revenue. Before that signed contract becomes money the company can actually keep, the roof has to survive the estimate, the weather, the crew's schedule, the material delivery, the inspection, the payment process, and whatever happens the next time it rains. That is what makes roofing so deceptive. Demand can arrive overnight. Production cannot. The price is agreed before every hidden condition is visible. The work happens outside under weather nobody controls. Material and payroll may leave the bank before all of the customer's money arrives. And one mistake on yesterday's roof can pull tomorrow's crew off a paying job. A roofing company can have trucks moving, contracts piling up, and more work than it has ever seen while the owner is quietly losing control of the business. So the real question is not whether roofs are expensive. They are. It is not whether people need them. They do. The question is, what has to happen between the first phone call and the final payment for one of those expensive jobs to become profit instead of another promise wearing your logo? There are several businesses hiding under the same name. One company replaces aging residential roofs for homeowners paying with savings or financing. Another works inside insurance claims after wind, hail, or hurricanes. Another installs roofs for builders and general contractors. A fourth repairs, inspects, maintains, and eventually replaces commercial roof systems. The trucks may look similar. The payment paths are not. The residential retail company depends heavily on local reputation, qualified leads, estimates, scheduling, and collections. The insurance restoration company adds adjusters, deductibles, depreciation, claim documents, and sometimes a mortgage lender. New construction work may offer volume, but one builder can control a dangerous share of the schedule. Commercial service can create repeat work from the same building, but it also creates response obligations. The first economic filter appears before anyone touches a roof. A phone call is not a customer. It may be a homeowner collecting 6 free estimates. It may be a property outside the service area. It may be someone who cannot authorize the work, cannot pay the deductible, or never allows anyone onto the roof. The company can spend an hour driving, another hour inspecting, and more time writing a proposal for a job that never had a realistic path to production. That matters because estimating capacity is limited too. The same person inspecting a weak lead is not inspecting the referred customer who is ready to move. Lead volume can make the sales dashboard look busy while the production board stays empty. The useful lead is not simply the cheapest one. It is the one attached to a real roof problem, a reachable property, a customer who can make a decision, and a payment path the company understands. The leaking house has all 4. That is why the company cares about it. For this story, stay with the leaking house after a storm, because that one job contains almost every pressure in the trade at once. The homeowner wants the leak stopped. The salesperson wants the contract signed. The crew wants a clear start date. The supplier wants to know where the material should be placed. The office may be waiting on a permit, an inspection, a claim document, or a check. Somewhere else, a customer from last month says water is coming in again. Owning the company means standing in the middle of those promises. The trucks and ladders are easy to photograph. The hard part is that every promise becomes due on a different day. You may own vehicles, trailers, fall protection equipment, software accounts, customer records, reviews, supplier relationships, and the right to use the company name. You may inherit employees or a network of legitimate subcontractors. You may also inherit workmanship obligations on roofs you never saw installed. What you do not control is the weather, the insurance carrier, the customer's mortgage lender, the building department, or an independent crew merely because it worked for the previous owner. And if the old owner personally held every important relationship, you may discover that the company was less transferable than the equipment parked in the yard. But before that matters, the company has to survive the first job. Before the crew reaches that house, the company is already spending money. The truck needs fuel. The salesperson has spent time on the inspection. The office has processed the contract. A supplier may want payment according to its own terms, not according to the customer's payment schedule. Payroll arrives on Friday whether the roof was delayed by rain or not. Insurance, software, vehicle payments, and the people answering the phones continue through every empty production day. This is the part that makes a small roofing company look lighter than it really is. It may not own a factory or a warehouse full of finished products, but it still has to finance the period between making a promise and completing it. A lean company can reduce the visible cost by renting equipment or using legitimate subcontractors. A larger company may carry employees, service trucks, a yard, and specialized equipment. Neither model escapes the timing problem. The business has obligations today attached to money it expects to earn later. That is why working capital matters before profit ever does. A job can be profitable in the final accounting and still make the bank account worse while it is in progress. The dangerous thing is not the latter. It is the promise attached to the signed contract. The proposal for the leaking house looks exact. Measurements, slopes, penetrations, tear-off, disposal underlayment, flashing, ventilation, labor, material. A clean document arrives with a final number down to the dollar. Then the crew removes the first section of the old roof. Underneath it may be damaged decking. There may be more layers than expected. Flashing may have to be rebuilt. Access may be worse than it looked from the ground. The disposal load may be heavier. A code requirement may change the scope. None of that necessarily means the estimator was careless. Some of the most expensive conditions on a roof are hidden by the roof itself. That is the first trap. The company agrees to a price before the building reveals everything the company may have to repair. Say the contract is worth $20,000. This is only an illustration, not an industry average. The company expects $15,500 of direct and job-specific cost, leaving $4,500 before fixed overhead. Now the decking and disposal cost $1,500 more than expected. Then a flashing problem creates a return visit and an interior touch-up dispute that costs another $1,000. The homeowner still sees a $20,000 roof. The company still records $20,000 of revenue. The crew still finishes the building, but the amount left before office payroll, vehicles, insurance, software, sales expense, and every other fixed cost has fallen from $4,500 to $2,000. The overrun was only 12.5% of the contract. It erased more than half of the expected contribution. Could the contractor issue a change order? Sometimes. Could a legitimate insurance supplement recover part of the additional scope? Sometimes. But discovering more work and collecting more money are not the same event. Somebody still has to agree that the work belongs in the contract or claim. Somebody has to approve it. Somebody has to pay it. Until then, the company owns the surprise. Now imagine the estimate was perfect. The material is in the driveway. The dumpster is ready. The homeowner moves the cars. The crew is scheduled for Monday. Then rain arrives. The roof cannot be opened safely. Monday disappears. The job moves to Tuesday. Tuesday's job moves to Wednesday. Then a delivery is late. Then one worker is unavailable. Then the forecast shows wind that makes the planned work unsafe. Look at the calendar from the sales desk and the company appears to be winning. Every square is full. New contracts are being added faster than completed jobs are coming off. Look at the same calendar from the production desk and it says something else. The company has sold more promises than it can currently keep. That is why a full schedule can be a warning. Backlog is valuable only when the price is still good, the customer is still committed, the material is available, the crew can complete the job safely, and the payment can still be collected. Otherwise, it is a row of people waiting for the company to perform. Why not hire another crew? Because roofing labor is not interchangeable. Height, slope, access, tear-off, material system, flashing, weather, and experience all change production. A crew that is fast on one roof may struggle on another. A new crew that installs quickly but creates leaks is not extra capacity. It is future repair work arriving early. Some companies use employees. Some use legitimate subcontractors. Some use both. But changing the label on the labor does not remove the need to coordinate the job, protect the customer, follow the law, and stand behind the result. Safety makes the limit even sharper. OSHA says falls are the leading cause of death in construction. In 2024, 389 fatal falls to a lower level occurred among just over 1,000 construction fatalities. That figure covers construction broadly, not roofing alone. But the meaning on a roof is obvious. Fall protection, training, anchors, harnesses, and safe weather are not extras added after the estimate. They are part of what it costs to produce the job responsibly. Now take every pressure on that one house and multiply it across an entire storm zone. Hurricane Ian made landfall in Florida on September 28, 2022. In the days and months after it, damaged properties generated an enormous insurance and repair pipeline. Streets filled with tarps. Homeowners needed inspections, sales calendars filled, material orders grew, crews arrived from outside the area. From a distance, this is what the perfect roofing market looks like. Then you step closer. A damaged roof is not a paid roofing job. A Florida insurance examination covering Citizens Property Insurance Corporation's residential Hurricane Ian claims through June of 2024 identified more than 47,000 claims closed with payment, nearly 14,000 closed with payment, and more than 1,600 reopened or supplemental claims. Those figures cover Citizens, not every insurer in Florida, and they are not roof-only claims. They do not prove that every unpaid claim should have been paid, or that every supplemental claim was underpaid. What they show is the shape of the pipeline. One file reaches payment. Another closes without payment. Another reopens. Another requires more documentation. Another may involve covered damage but a disputed scope. Another homeowner may be waiting on a check that includes a mortgage lender. Another may not understand that the deductible remains their responsibility. Now bring the leaking house into that storm. The contractor has inspected the roof, written the estimate, answered the homeowner, photographed the damage, and reserved production time. The material may already be ordered. The crew may already have a date. But the money still has stages. Damage is discovered. Coverage is evaluated. Scope is discussed. A contract is signed. The roof is completed. Documents are submitted. The contractor collects. Every stage can create labor. Only the last one puts collected money in the company's account. Insurance terms matter here only because they change timing. Actual cash value generally means replacement cost minus depreciation. Replacement cost coverage may involve an initial payment and a later payment for recoverable depreciation after the work is completed and documented, depending on the policy. The deductible normally remains the homeowner's responsibility. If a mortgage lender is named on the check, another endorsement may be required before funds move. Not every roofing job follows that path. Cash work, financed work, builder contracts, and commercial projects move differently. Even insurance jobs vary by policy and jurisdiction. But the owner has to know which dollars exist now and which dollars are still expected. Picture the homeowner holding the first check at the kitchen table. To the homeowner, it looks like the roof money. To the contractor, it may be only one stage of the roof money. Part may reflect depreciation. The deductible may still be due. A lender may have to endorse it. The final amount may depend on completed work and submitted documents. Meanwhile, the material is already outside. The crew has another opening later in the week, and the stain near the ceiling light grows every time it rains. Nobody in that room has to be acting dishonestly for the economics to become dangerous. The homeowner sees a damaged house. The supplier sees an account balance. The crew sees a scheduled workday. The contractor has to connect all three without spending money that has not arrived. Assume the job has $8,000 available early. The company then commits $11,000 to material, delivery, disposal, and near-term labor before another $8,000 becomes collectible after completion and documentation. The contract may still be profitable. During the work, it creates a $3,000 cash gap. One roof does not look dangerous. 10 roofs at the same stage create a $30,000 gap. 20 create $60,000. Now place those 20 jobs inside the busiest month the company has ever had. The sales board rises. The supplier balance rises, payroll rises, the number of customers waiting rises. The owner has more future revenue than ever before and less free cash than expected. This is where the storm changes character. At first, it looked like demand. Then it became a test of whether the company could estimate finance, schedule, complete document, collect, and stand behind many roofs at the same time. The company does not become healthy when it sells a roof. It becomes healthy when that roof moves through the entire system without breaking the system. The useful economic unit is one correctly priced job, assigned to safe and capable production, completed to the promised standard, collected and unlikely to consume another crew day later. That is what the company is really trying to produce. A completed and collected day of roofing work. Now the earlier numbers change meaning. A cheap lead is expensive if the property is outside the service area. The homeowner cannot pay, the damage is not covered, or the customer never allows the inspection. The company spends estimating time and creates no production. A large contract is weak if the access, hidden conditions, payment terms, or customer concentration are wrong. A fast crew is slow if its work creates rework. A full calendar can still be empty of completed and collected jobs. And even after the money arrives, the roof may not be finished with the company. 6 weeks after the leaking house is completed, the customer calls again. Water has appeared near a penetration. Maybe the problem is workmanship. Maybe it is a material defect. Maybe a later weather caused new damage, maybe another part of the building is responsible. The cause matters because a manufacturer's material warranty and the contractor's workmanship warranty are different obligations with different terms. But before the cause is known, somebody has to go back, a technician drives out, the roof has to be accessed, the area has to be inspected, the customer needs an explanation, photographs may be required. If the problem belongs to the contractor, it needs to be repaired. If it does not, the company may still spend hours proving why. The replacement material may cost almost nothing. The day does not. That service truck was supposed to inspect another roof. The technician was supposed to complete a paid repair. The old job has reached forward and taken capacity from a new customer. Callbacks borrow tomorrow to pay for yesterday. This is where the storm pipeline can turn into a chain. A rushed estimate creates an underpriced job. An overloaded schedule creates a rushed installation. The rushed installation creates a callback. The callback displaces a new job. The displaced job delays collection. The delay increases the cash pressure created by the next group of contracts. No single event has to destroy the company. Each one only has to make the next one more likely. A careless operator can hide this for a while. Contracts still get signed. Trucks still move. Revenue still appears. But the company is using future crews, future customer trust, and future cash to repair decisions that looked profitable when they were made. The disciplined company behaves differently, and not because it somehow eliminates weather or hidden conditions. It slows one part of the system before the whole system loses balance. Sales stops promising dates production cannot meet. Estimators identify the roofs where uncertainty is too large. Material is ordered against a real schedule. Safety is funded inside the job. Collections are tracked before another wave of work is accepted. Callbacks are not buried inside a general service calendar and forgotten, and the company becomes very careful about what it is actually building after each roof is complete. A residential replacement company may finish one roof and hear nothing from that homeowner for years. It has to keep finding new attention. A commercial service operation may inspect, repair, maintain, and eventually replace the same roof over time. Professional roofing organizations recognize formal long-term maintenance agreements as part of the trade. That does not make every maintenance agreement profitable. Service trucks, trained technicians, documentations, and response time all cost money, but the relationship changes the pipeline. The company already knows the building, it already knows the customer, it may already know which section will fail next. The visible work is one repair. The durable value is that the company does not have to meet the roof as a stranger every time. Now imagine two roofing companies with similar annual revenue, similar trucks, and crews wearing equally clean logos. In the first company, the owner's phone is the operating system. The best leads come through the owner. Difficult estimates wait for the owner. Crews call the owner when the decking is bad. Customers call the owner when payment is confusing. The supplier calls the owner. The owner decides whether a leak belongs under warranty. The company may produce excellent income, then the owner disappears for a month. The trucks still exist, the contracts still exist, the company names still exist. The invisible connections between them begin to fail. In the second company, the roof file carries the story. The measurements are there, the assumptions are there, the customer communication is recorded, the schedule is real. The payment stage is visible. Warranty responsibility is clear. More than one person knows the supplier, the crew, and the customer. The owner still matters. The owner is not the only bridge between every moving part. That is the difference between buying a company and buying a demanding job that happens to have employees. So does owning a roofing company work? It can. But the answer is not hiding in the price of shingles, the number of trucks, or the size of the sales board. It depends on whether the company can keep one roof from becoming 3 different problems at once: an estimating problem, a production problem, and a cash problem. Go back to the first image. The rain has stopped. The phone is ringing. Material is sitting in a driveway. A crew is climbing onto the leaking house. Somewhere in the office, a signed contract shows a large number. That number is only the beginning. The company earns its money by carrying that roof through every point where the job can change. What is hidden underneath it? Whether the weather allows it, whether the crew can perform it safely, whether the documents match the work, whether the money arrives, and whether the next rain leaves the homeowner dry. Then the next rainy day arrives. The homeowner looks at the ceiling light. No water. The crew that installed the roof is already earning money somewhere else. The supplier has been paid, the company has collected. The owner's phone does not ring. That is when the roof finally became more than a large invoice. That is when it became a business.